Hey, welcome back to Two Stupid Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And holy crap, this week was wild for the stock market. We have like news going off in all sorts of different ways. Even this weekend, we're getting wild news. We're going to talk about some of the recap about major economic events that could be on the cusp of something big. I don't know. Maybe. See. Yeah. So this chart we'll get here in a minute in the background, but this is kind of a really interesting thing that we've
Yep.
been talking about for a while that finally looks like maybe it's getting close to happening. So we'll get into that a little bit later. But big week for the market. It was kind of all over the map. Particularly, you had mega cap like tech stock earnings, and those tend to really move the market. We did a separate video on Meta. But some of these companies are coming in performing relatively well, putting on big sexy growth numbers. Other companies are just like absolutely crap in the
Tanking.
bed. Intel
Yeah.
laying
Oh.
off 15% of the workers, 15,000 jobs lost in that earnings report, which is bananas. But yeah, it's been a wild week, all right, and it's even this weekend we're learning some crazy stuff. But SPY down 2.4%, even worse for the triple Qs, 3.67%, and then my beloved Russell 2000, which was up like 10% in a month, gave it all back this week. It's crazy. I'm
Yeah.
starting to crap my pants. Not really, but
I can buy more.
look at it. Yeah. So Powell spoke this week too, which was like another minor little news story here, talking about the fact that no rate cut this week, but the next meeting's in September. They get a nice little break. They're saying maybe the next one will finally start cutting rates. Maybe, just maybe. But the funny part to me, this little quote here. I don't think of the labor market in its current state as a likely source of significant inflationary pressures. So would not like to see any material further cooling in the labor market. All right. So this is you remember the Federal Reserve has a dual mandate for
Yes.
keeping inflation under control, but keeping unemployment to the maximum ability. And of course, we got our labor number like 2 days later, and the unemployment rate has jumped from 4.1 to 4.3%. So this is
Hefty
exactly what I was
jump.
hoping not to see.
Yeah. Is not all what he's hoping to see. And remember, guys, we did this last time he spoke. It was chilling between like 3.6 and 3.9 for like a year. It was forever. It was a long time. This
Yeah.
rises very quickly when it happens.
Yeah. Dylan's gonna got a nice chart for you on that one.
S yeah. So essentially, this is the unemployment rate going back all the way to like 1948. I think. Let me move your face. I think it's
1950.
1948. Yeah, 1948. So you
Yeah.
can see as we start to see the cusp right before these gray lines of recession, as it starts to curve upward, it happens incredibly rapidly, which we've kind of already seen going from 3.6 to 3.9 in a matter of like 12 months, 3.9 to 4.3 in a matter of 2 months or whatever it was. So as we start to increase in unemployment, you have multiple factors that can happen at once, which we're also going to talk about that are not good, and they can kind of cause a little bit of a spike, which is not ideal. But if you're in TLT, it is nice. I feel bad.
Just to put another way of displaying the number of jobs created by the economy, slowly cooling off over time. Pretty easy to draw in your mind a nice like downward progression of this downward sloping line in terms of number of jobs being created each month. This one came in below estimates, which was one of the things that really kind of upset the market this week. I think they're looking at 178,000 jobs created, like
Yeah.
to 114,000, and they downwardly revised June, of course, as well, which has been the trend for a little while. I don't know if you want to talk about this
Yeah.
slide.
So this is the Sahm rule. Now, full disclosure, I was not super familiar with this, but it involves unemployment. So essentially, it's the unemployment rate's 3 month moving average, moving 50 basis points above its 12-month low. That just happened. And you can see here, I'll move my face here. So going back recessions to November 1953, you can see that the recession starts right around there 2 months beforehand, 3 months beforehand, whenever it happens. It has been correct 10 or 11 times. And I will say, so this time, this point 40 is wrong. But Sahm did come out and say, here, go to the next slide,
Mm-hmm.
that this one may be the one that's different, which I feel like they would say every single time, due to increased labor supply due to immigration trends. So take it with a grain of salt.
Yeah, certainly. I mean, I think Powell mentioned something about immigration and being a driver of GDP during this current economic cycle too. So we're still seeing positive GDP growth, which is another number we had reported recently,
Yeah.
and that's been in part due to influx of folks more demand for goods and services, right? So this is now the prediction after all this data. This is as of Friday. What the Fed's going to do at their next meeting in September, right? So they get a nice little break here. Mind you, that the rate right now is at 550 basis points. They're calling for 78% of people saying they're going to get a 25 basis point cut, and then 22% are saying we got to get a 50 basis point cut at the next meeting. There's literally no one calling for no rate cut at all at this point for the September meeting, which is crazy.
That is pretty wild. That escalated quickly. Yeah,
Yeah.
that unemployment thing really changed things.
Well, the other thing too is like notice this trend now. Now you're seeing that the kind of midpoint here is now calling for like almost 1% of interest rate cuts in the next several meetings, like 3 meetings
Yeah,
before the end of this year, which is
I think it was
crazy.
Chase or Morgan Stanley was calling for 150 or 200 basis points or to 2%, which is it's
Yeah.
crazy. That's too much. I don't think it's
Well,
going to
it's
happen.
just funny how far we've swung to because like the March, Fed Reserve basically they were saying that they were going to have 3 rate cuts this year. And in June when we got their report, it was saying only one rate cut this year,
Yeah,
and now we're back to like three, maybe four.
yeah, it's crazy.
Yeah. And like this is another kind of sign about how fast things are moving. This is from Mortgage Rates Daily, and the 30-year like national average mortgage rate went from 6.6% on Thursday to 6.4% on Friday. Yeah, yeah, a quarter
Man,
point move in the 30-year national mortgage rate basically in a day.
it's insane. Imagine
Yeah.
closing a week ago. That'd
Yep.
be so shitty.
Well, the good news is you have a real chance at maybe refinancing to a better rate in the next 12 months.
True. True.
Um,
Good point.
So this is that 2 year 10-year bond inversion, and we've talked about this for a while. Like we were in the longest period of rate yield inversion in like history of the market. Right? It was just crazy to think about. And look at this move in the last like few days. We're really getting close to becoming uninverted. Which, if you go back and look at another indicator, this isn't as good. We've talked about this before, but these shaded areas, recessions, right? So like when you get that uninversion, that typically is like immediately preceding a recessionary time period. So it's something we may be on the cusp of uninverting here, which would be another driver of economic doom and gloom scenarios. This is another point I wanted to make here when we're talking about inflation. Now, Powell said if we continue to see kind of good evidence inflation is cooling, inflation is a 12-month rolling number, right? And we're hanging out like that at mid 2% range right now. All of a sudden, once we lose this August bar right here, which is a 0.5%, the largest bars we'll have left is like 0.4% in a month. And now we're actually even starting to see like this most recent data point was negative, right? So it's going to be much harder for us to have a 12-month CPI number that is above that 2% number. It's going to be much closer to in line with the Fed's target, like almost overnight. Once we lose that 0.5% in a month, which will be something that we'll see for the September data
I do
coming.
think the last 0.5% is still going to be sticky as hell, unfortunately.
Yeah, and then I'm not familiar with
Yeah.
this chart.
So we're kind of talking about things that are risk to the market, right? Risk to investments. Obviously it's not directly investments, but recessions or bad economic outlook or rapid increase in unemployment, almost always the stock market does not do well, right? So this is another one that's still under the radar and not a lot of people are talking about. Is there's a commercial real estate collapse kind of about to happen. So this total vacancy, 18.1% national, is 18.1% of commercial buildings are completely vacant. So almost 1 in 5, right? And then you have biggest cities in there. Boston's actually doing pretty great, but everyone else not doing ideal. San Francisco, I'm assuming. Oh, they're not on this. Well, they're the worst. I think they're at 25. It's getting a little bit scary, and then you can see the 12-month change in percentage. So not ideal.
Yeah, yeah. I mean, it's kind of a mixed bag here, whether or not they're positive or negative, in terms of the changing percentage there. But yeah, there's a handful that are going up.
Yeah. And then also, so here's your office. There's just office, industrial, retail, and apartment. Look at that office space, man. Just shooting towards 20. That is terrifying. And why it's terrifying is because in 2025, we're going to have an additional 570 billion in loans scheduled to reach maturity. So essentially, you have about 2 trillion of commercial real estate in the next 2 years about to reach maturity that are going to have to refinance at a higher rate. That is going to be a huge problem. This usually is not a big deal for your Bank of America, your Wells Fargo, yada yada. It's usually regional banks which had come back. They've come back pretty well.
Hmm.
I That could be a big problem, right? You start to have unemployment going up and then banks closing.
Yeah,
Not good.
yeah. I mean, lots of doom and gloom scenarios could certainly be painted from that.
Yeah. Speaking of the king of doom and gloom, who's which, by the way, I hold zero weight to this. To be very clear, zero weight. All right. When you track how many times eventually you're going to be right every time. He does one every 4 or 5 months, and he's so dumb. He actually puts specific months. If you just go
Yeah.
back to 2020 to 2024, he's done like 6 or something specific months where it's like crash 80%, and then it just doesn't
Mm.
happen. This new one is 86% in the S&P and 92% in the Nasdaq sometime in 2025. This was revised to May. He did a specific month again, 2025. I
Nice.
don't that would mean the Qs are at like 50. I just don't
Yeah, that's perfect.
think that's no. Come on.
Yeah.
I'm like
I mean,
so stupid.
at that point, yeah, I would be taking cash advances on my credit card to buy more
Same.
indices, but
Yeah, the average PE of the market would, I mean, like Apple would be a PE of like 6. Like I don't like it
yeah,
doesn't make any
zero point
sense.
0.5.
Yeah. Okay.
uh,
Now this guy does have a lot of weight. He just did something. He just sold half of his Apple stake. Half.
yeah.
This dude is sitting at 277 billion in cash. Now, there is some discrepancy of this number, but his average cash to assets has been 13% of total assets in cash since 1997. He's now chilling around 26% to 34%, depending on where you look, which is still at
Wow.
least double. So,
Yeah.
I don't know. He seems to know what he's doing a little
I
bit.
mean, the few thoughts there. One, he always tries to keep higher cash because he runs insurance companies, and insurance companies need to be solvent in the case of really bad things happening to the economy. Two, cash is paying really well right now. I'm sure on that $277 billion, he's probably earning $15 billion in interest alone a
Probably.
year, which is crazy to think
He has a
about.
bunch of T
Um,
bills, too.
yeah, yeah, exactly. And then three, like, yeah, man, I'll be honest, I let a good portion of my Apple shares get called away from me because, we're looking at, I love Apple, don't get me wrong, I'd love to own it again at the right price, but we're looking at a company with single digit earnings growth, revenue growth, and then you're talking about paying in the 30 PE range for that, which just to me, those two things don't go together. So I'm less uh, I would say less inclined to hold Apple shares at this point. So, and also, he talked about long-term capital gains potentially. If we see a change in governmental authority here, as far as president of the United States, we might see an increase in capital gains taxes. So he wanted to just lock in those profits now at the lower capital gains tax rate.
Yeah,
So,
he also sold Bank of America.
mhm.
Not all of it, just a lot of it.
Yeah,
So we have our 5 problems. In addition, Bitcoin in the last day, I don't know why when Bitcoin tanks, the market tanks. It makes no logical sense to me. I'm sorry, but it is down like 6% in the last 24 hours.
yeah.
So there's that. I don't know the weight. I would actually hold more weight to that than Harry Dent. Funny enough.
It's still officially the worst hedge on earth.
Yeah, no, I agree. It doesn't make any sense to me, but for some reason, sometimes they go in tandem. So I figured
Yeah,
another fact. All right,
yeah.
guys.
I'll catch you next one.